from why logistics and how it contributes to our economy to talking about what we should be doing from an infrastructure standpoint. Absolutely marvelous. Thank you very much for your insight.
Can you speak closer to the mic?
Yeah, sure. I can. I thought I was loud enough, but guess not. Our next speaker needs little introduction. Professor Rajiv Malhotra. He bridges the world of economics and policy making, and he has been working as a professor and executive director, Center for Development and Finance at the School of Government and Public Policy at OP Jindal Global University. He has conducted a tremendous amount of research in the areas of public policy, and which includes conceptual and empirical framework on macroeconomic issues in the development policy, fiscal policy, and budgeting, poverty estimation, human development, human rights and development, so it just goes on. So, Professor Rajiv Malhotra, please.
Mr. Sivaselam, Professor Rajkumar, Vice Chancellor, Dean Professor Bhardwaj, Professor Ramachandran, distinguished panelists to follow, faculty members, ladies and gentlemen. It is indeed my pleasure to be here this morning. In fact, I had been looking for an opportunity like this to share some of my own thoughts on this very topical and interesting issue. But before I get into that, let me start by congratulating Vice Chancellor Professor Rajkumar. We just heard a couple of minutes ago that our university has been given the tag of Institution of Eminence. That indeed is a great achievement. And we are starting this day with that lovely announcement. I think it opens up, and it opens up a whole lot of opportunities for us as we go forward. So let me come back to the theme that I have been asked to speak on. There's a lot, ever since the announcement of India going to be a 5 trillion economy was made in the budget session. In fact, the work on this started well before the budget session. Mr. Sivaselam would be aware of it. Even as the Prime Minister was out campaigning in the countryside, he had given instructions to explore what would it take to make India a 5 trillion economy. So the work was in progress. A lot has been written since then, and we have come a long way. But everything that needs to be said on the subject has not been said yet. So there is scope to add to the debate, the discussion, with the single objective of trying to prioritize the policies that we need to take now and as we move forward. And more importantly, to anchor the transition that we are going to see in the coming years in an institutional framework. It was addressed in the passing by the previous speaker, but I'll come to that point a little later. So there is something to be said, and I'm going to share my 2 bits on what needs to be done as we look forward. I would start by looking at this theme in 3 parts. The first part is to pose a question: do we need a target such as the one that is before us now? Do we need it? Second, is it feasible? Is it realistic? That would be the first part of the talk. The second part would be to look at what needs to be done from where we are today. Remember, this target has been kept before us to be met within a short span of 6 years. We are expected to be a 5 trillion economy in 2024-25, fiscal 25. That's not too much of time. So it does beg to look at how feasible this target is, what are the kind of trade-offs that this target, this objective imposes on policymakers, And then I go into the next part where I would like to discuss what needs to be done from where we are at present. We realize that there has been a significant slowdown in our growth momentum, especially in the recent quarters. And this slowdown needs to be reversed and reversed quickly. And then one needs to build on and regain the momentum, the kind we saw in the earlier part of this millennium. The third part of my talk would look at the whole issue of sustainability. I think the story would not end just at getting to that 5 trillion benchmark, whether in fiscal 25 or in fiscal 27, that remains to be seen. But the important part is what needs to be done to sustain that momentum going forward. If you look at the history of the world, and especially the history of the last century, 14 countries transited from a developing status to a developed status. And all 14 of these countries were able to do so because they sustained a high growth trajectory for a considerable period of time, for 3, 4, 5 decades. We need to do something like that. And so a set of issues that talk about, that concern and address the whole issue of sustaining this growth momentum over an extended period of time would be my third part of the talk. So let me start with the topic, the topic that is before us, namely, is this target required in the first place? And if yes, is it feasible? How are we going to get there? Vice Chancellor, in his opening remarks, actually answered part of the question. He said the need for aspirational benchmarks. And we need aspirational benchmarks not only in our own lives, but also as a collective body. We have noticed that we have given up a 5-year planning system. We don't have something to anchor the framework of policies that need to be considered as one plans, as one looks forward to taking the economy on a higher growth trajectory. We need some goalposts, we need some benchmarks. And in that context, it does make sense to set up ambitious, aspirational benchmarks. This is one such benchmark. But just doing and setting up a benchmark is not enough. What is more important from our point of view is what kind of a strategic action does it unfold? When we talk of China and India, and later on in this conclave, there's a session which looks at comparing the Chinese model and whether India should be following that model. One thing that strikes very clearly is the strategic nature of Chinese planning. They set up a goal which may be as distant as 20 years from now, and then they unfold the framework of policies, the institutional changes that are required to reach that benchmark. A very strategic approach. So I like to submit that when we set up these aspirational benchmarks, especially in our current context, we need to focus on a strategic framework which can concert the different stakeholders in the economy, not only the government, but the private sector as well. Not only the private sector, but the private initiatives from abroad, from outside, and concert each one of us as a consumer or a saver or an investor. Now that strategic framework is something that we need to look at. And I look at this target as a means to dwell on preparing that strategic framework and then making sure that we implement that strategic framework. That is why I think this target could be important. But there are skeptics on the other side who would like to argue that is it something that we have seen in the last 4 or 5 years, namely creating interesting sound bites and to divert public opinion in another direction. We don't want to look at this target or this benchmark in that context. We want to look at it in terms of what strategic action needs to be taken at this juncture in our life to bring together and create a cohesive policy framework, a policy environment for moving forward. So I would argue that we need such benchmarks, but my final kind of judgment on whether this benchmark is a good one will come right at the end of my talk. I move on now to the feasibility part of this topic, the feasibility part of this target. There are three elements to it: the real GDP growth rate, the inflation rate, and third, what happens to our exchange rate. Now, some of you would have seen in the media that there is a talk that this benchmark requires a real GDP growth rate of about anything between 8 and 8.5%, assuming that there is an inflation rate of about 4 to 5%, well within the mandated range of Monetary Policy Committee, which is 4 plus minus 2%, and that it requires a reasonable stability of our exchange rate. Now, when you look at the numbers that are there right now in front of us, growth is slowing down. There's no doubt about it. It took us a bit of a time to recognize it. We ignored the lead indicators, and it was only now when GDP in the last quarter touched 5% that the alarm bells really started ringing. But in fact, this slowdown had set in around 2010-11, and I'll come to that a little later. But the realization of the fact that there is a problem is the first step in trying to address it. Now, I would argue that if we look at our recent past, and we look at a recent past when the economy was facing good tailwinds, in other words, the global economy was doing well, we clocked well past 8%. We clocked 9.5%. So growing at that pace is feasible. I would, however, like to point out that if you look at the long-term growth statistics of the Indian economy, the trend growth rate, let's say post-economic reforms in 1991, would be around 7.5%. This trend rate, or the potential growth rate, had shifted somewhat to 8.5% in the first decade of this millennium, when the world economy was booming, and we enjoyed that boom, and we kind of rode the tides coming out of this booming economy. As a result, in that first decade, we clocked something close to 9%, 8.5%, 9%. But that is no more a possibility. With the global slowdown being as widespread as it is, we are not going to be lucky to have those tailwinds, the favorable tailwinds that we enjoyed then. In fact, we are going to face stiff winds at the front end, coming from the kind of policy uncertainty at the international level, the trade tariff war between US and China, the uncertainties around the oil economy in Gulf, the Brexit, we don't know how it is going to pan out. All these factors suggest that we are not going to have those tailwinds as we had earlier. And that brings me to suggest that our potential growth rate is not 8, 8.5, but is about 7, 7.5. We should recognize that. And if we want to take it up beyond 7, 7.5, we have to look at new pathways for pushing growth. And that's where the focus has to be. So there is this talk around 5 trillion economy that exports have to clock, and Secretary Commerce would be in a better place to say, to suggest as to what they are trying to do to take the export targets to 1 trillion. I don't think it is going to be very realistic to pin hopes on that kind of a push coming from the external sector. We need to find our growth pathways domestically. And I'll come to that in a bit. But what I would like to say about the feasibility of the 5 trillion benchmark is, it is feasible. And it is feasible with several combinations of real growth rate, inflation rate, and exchange rate, rupee-dollar exchange rate. There's every reason to believe that if we are able to attract capital inflows in the kind of numbers and amounts that we have seen in the recent past, there's no reason to believe that we would not find some appreciation in our rupee. But that could be at the expense of our export targets. And so there is a fine balancing to be done insofar as the macroeconomic balance that underpins a 5 trillion economy is concerned. But more on this towards the end. Let me now come quickly to what needs to be done when we move forward. But before even saying that we need to do A, B, C, D, we have to analyze what is going wrong in our economy. Why is there this slowdown? Why is it that it has taken us so much of a time to figure out that this slowdown is serious and we need to address it? Now, if you look at post-2010, right after the global financial crisis, when, like all emerging economies, we resorted to a fiscal stimulus, a major fiscal stimulus, which ran up to almost 4% of our GDP. And we saw that it did impact, and we had a quick rebound. But this rebound did not last for long. And there are a whole lot of factors that kind of vitiated the policy environment, the political and policy context of growth in India. To start with, and I'm talking of the UPA 1 period, to start with, we had a ban on iron ores, followed by the ban on coal allocations, and in fact, revoking of coal mining rights. This was followed by the delay in environmental clearances, which kind of added to the negatives on the policy environment. And then if this was not sufficient, we had the 3 C's coming into play: the courts, the Central Vigilance Commission, and thirdly, the Comptroller and Auditor General of India. The 3 C's had their role to play in the slowdown that we witnessed. In fact, popular media described this phase as the phase of policy paralysis. We had a change of government. Some hopes were rekindled. And there was a lot of expectations. But the political discourse, again, perhaps contributed to derailing the recovery that was coming and was being observed on the horizon. The 2 major shocks to the economy, demonetization, followed by a hasty implementation of GST, did their bit to derail the recovery and contribute to weakening the overall investment environment in the economy. Even as the new government was taking charge, the NPA crisis was already building up. There is a perception in among some of the analysts that perhaps the government was a bit slow in trying to recognize that this needed to be addressed. There was an accompanying problem of farmers' distress, essentially not on account of agriculture production not keeping pace, but the fact that income stabilization was not happening as the way it should have happened, which contributed to the distress, the strengthening of the distress in the farm economy. Coupled with the crisis out of NBFCs and the squeeze on liquidity in the economy meant that the industry was facing hard time insofar as its needs for credit were concerned. At the same time, the agricultural economy, with the kind of stress it has acquired and accumulated over the last 2-3 years, yes, I'll take 3 minutes. You don't need to remind me again. Had created a situation where a demand side constraint also started surfacing. So we had the potential output trailing behind because of supply side factors essentially related to credit availability, and on the demand side, agriculture, with its terms of trade going against it, started creating a situation where the slowdown became more visible and stronger. What then is the way forward? The way forward is to quickly undo these trends. We need to first focus on agricultural sector. We need to see how we can change agricultural terms of trade. In fact, if you look at agricultural GDP at current prices, which captures the revenue that agricultural produce garners, you will find that over successive quarters, it has been far smaller than the real growth in agriculture GDP. In other words, farm sector is not getting the remuneration that it should be getting, and that is holding back agriculture demand. We need to correct this terms of trade going against agriculture. The second thing that we need to look at is quickly recapitalizing our banks. But this cannot be at the expense of fiscal indiscipline. There has to be other ways to do this, and that is now available in the form of the exceptional transfer of reserves by RBI to the central government. But that won't suffice. That will get the economy going. We need to also fire the animal spirits. This actually calls for some big bang reforms, including privatization. We have just clubbed 27 PSU banks into about 12 in the last round of consolidation that we have announced. But we need to take a step forward. We need to privatize some of them. We need to privatize some of the big ticket items on our table. Air India is on the list. We need some of these big reforms to spark the animal spirits back into action, into moving forward. But my main concern is not these cyclical factors. They can be handled. The main concern is with the more entrenched structural concerns. Today, if you look at the savings and investment rate of the economy, today we are saving and investing around 30-31% of the GDP. This is the level that we had attained in 2003-04. In other words, from that level, we went up to 35, 36, 37, and we're now back to what is happening to our savers. Why is the saving declining? Of course, there is this saving on part of the government, but not so much. That doesn't explain, and even corporate savings does not explain this. Households are saving less. Why? Is it because they are losing their purchasing power? No, not necessarily. It is, in my view, an outcome of the fact that in the last 10 years, we haven't generated enough employment opportunities. It is the reverse of the argument of demographic dividend. Why does demographic dividend helps in raising the growth trajectory? Because with more people getting jobs, more employment opportunities would then create more savings for the economy and hence more investments, and that's how the virtuous cycle gets built in. But the fact that employment generation has not happened at this level as it should have happened is a major concern. It is actually questioning the sustainability and the arguments that we have been peddling around the demographic dividend seriously. Because time is short and I guess I have taken up most of my time. I just want to look at just one last issue. What is the ground reality on the investment climate? There are 4 or 5 things that are happening. There is the National Company Law Tribunal, which is functioning with an overdrive. SEBI has some guidelines to be followed on independent directorships. The tax authorities are flexing their muscles. They want to improve tax administration. There is the RERA, the Real Estate Legislation and Development Act, which is posing huge problems in the real estate sector. And there are certain unpredictable policy announcements being made almost every other day. The latest was a 2% TDS on cash transactions of above 1 crore, which has now been questioned in the agriculture sector, especially in the APMC transactions context. So what I'm trying to say is, we may get the macro picture right, but we have to get the picture on the investment climate right at the ground level. And there is a lot that needs to be done, which has to be addressed on a priority if we have to turn and reverse the trend that we have seen in the last few quarters and start building up on the growth momentum. One last point, and I stop with that, and this is a point that actually needs to be communicated by the government to the stakeholders, to the economic stakeholders. What is it that the government is trying to do? Government is trying to reform the way business has been done in this country. How has the business been done in this country? It has been done through patronage, through tax and subsidy regimes, and one has elicited most often some kind of a response from the business entities. But this is not how. This is the kind of institutional change that the previous speaker mentioned that we need to do or make or undertake as we start aspiring for a 5 trillion economy and beyond. The moment we start realizing that the way the business has been done in the past has to change, we have to prioritize and perhaps sequence the policies in a manner where it is not destabilizing as it has been in the current context. In fact, we are witnessing what we call a inverted J-curve phenomena, or rather a lying J-curve phenomena. What is that phenomena? That phenomena is when you make a lot of policy changes, make structural attempts at changing the way business is done, the way economic activity is carried out, output and productivity declines first. And it's only with time that it starts picking up. We had one such J-curve phenomena in the late 90s after the first round of reforms. I think we are witnessing another J-curve. But the challenge is we have to turn the J upside very quickly. And that really requires for a huge concerted, synchronized policy action at several fronts. And policy action at the ground level, not necessarily at the macro level. More or less, we are on track on the macro level, but it is at the ground level where changes have to be made. I'm sorry I took more time than what I wanted, and I'm not able to cover up a couple of points that Dean Bhardwaj wanted me to touch upon, but I think I'll stop here in the interest of time and in the interest of not creating a domino effect here and delaying every other session after this. Thank you very much.
Thank you very much, Professor Malhotra. That was a very insightful journey for us, very clearly articulating what is it that we need to do, how do we get there, and what is the challenges. I think that is fantastically described. We are running a few minutes late, so we'll try to catch up. So this session is now done. Sorry? Yeah, so we can take 1 or 2 questions before we wrap up and go for break. So are there any questions from the audience? And don't feel shy at all.
Particularly to our necessary asylum. I have
Please. No, I'm sure there are, but they're just shy.
Okay, so I'm asking this deliberately because. Yeah, so I'm asking this question because in our classrooms, when we teach the concept of size of the economy and related issues, then we approach it in a slightly different way. So I want the students to take the right message home. So this vision is based on IMF's projection of 4.7 or 4.8 trillion. And then it's measured in terms of nominal USD, which means that the goal is dependent on how the dollar is going to be valued in 2024, and which is again something beyond the control of any major stakeholder, including Government of India. Now the question is, with this background, isn't it more important to focus on real income in rupees per capita, which tells people more about their purchasing power, rather than nominal income of the country in dollars?
See, I will. I'll put it like this. See, first of all, it's not for people who are doing finance majors, and it's not too difficult to estimate what your. No, it's quite okay. It's not too difficult to estimate what. What is the expected rupee rates? People do it. Financial modeling does it on a regular basis. See, I would only like to give you some flavor. The knowledge of inflation is particularly crucial. Now, in a country like India, where the inflation will be, the actual inflation will be about 7 to 8%. And the US inflation will be about 0.2, 0.3% or certainly less than 1. You can always expect that the Indian currency per annum will depreciate 7%. It's a given. Otherwise, there'll be an arbitrage which you can gain by just doing business in dollars. A simple arbitrage will give you a 7% return. So the rupee will always, as long as this inflation is reasonably predictable. Nowadays, even our inflation projections are available quarter to quarter on quarter. It's always possible to know how the devaluation or how the rupee will move. So unless and until the inflation-related issue is addressed, the depreciation rupee depreciation is a given thing. It cannot be changed because that inflation is a key factor. Now that is on one side of it. The second thing is, yes, the real incomes of people was what Professor Rajiv Malhotra also mentioned is actually crucial. The key element that comes about how much of the rent-seeking behavior in the economy you are avoiding. Take, for example, logistics. The rent-seeking behavior is 130%. So your exports become uncompetitive, your import becomes costlier. See, in India, since this was not a subject on logistics, I didn't speak about it. In India, you create borders everywhere. Every state you have borders. Now it is eased up because of the GST, but the national borders remain. Every port is a border. You create borders, you create customs, and you raise service costs. And if you look at if your institute does a cost analysis of it, the rent-seeking behavior by sheer creating border is 130%. What happens? Because you are on FOB basis, or in whichever way you send it, the exporter has to bear the price. So his effective cost goes down even in exports. So the amount of money which an exporter should get, he will not get it because he has to pay at the borders. You look at it on the flip side of imports. Because you have to pay at the borders, you end up paying an additional cost. And a whole industry by which we can have imports for value addition and exports is totally out of the window because you have to pay 2 times the cost at the borders. One for inlet and one for outlet. And 130% each way, which means 260%. I mean, no efficiency parameter will give you an efficiency of 260 parameters. Efficiency parameters, you talk about 10%, 20% maximum. I mean, whatever you might say, you cannot talk of an efficiency more than 100%. Isn't it? Therein lies the rub. When you look at the internal, as Professor mentioned it very clearly, when you look at the internal dynamics of the Indian economy, you are actually much costlier than what you should actually be. In all this agrarian crisis, that no trader has committed suicide. And the trade is actually flourishing. So when the trade has to retain its margin, the impact falls on the person who supplies, the same as in export trade. So you find the cost going down because the logistics is not a virtual game, it's a real game. You need to shift. I'll give you an example. You look into the ENAM website, do some study on that. You will find that agricultural markets, today the prices are available everywhere. If you find that the price in a particular market or a mandi is, let us say, 1 rupee, you find, and you look at the Delhi market, and you find that it is 10 rupees, even after 2 weeks, there it is 1 rupee and here it is 10 rupees. Why? Because there is no access available, even though information access is available. Because correspondingly, the trade occupies to make it unviable. So you don't have an integrated ecosystem of multimodality. If one set of parameters, let us say 1 rupee, acts in your favor, the logistics ecosystem will act against you. So a 6,000 rupees freight will become 30,000. So the whole access will not occur. The key element, as he rightly put it, is look into the devil is in the details. And therein our entire, what I would call the final money where it should lie, is actually eaten by intermediary trades. I don't say intermediaries don't perform an important function, but they are overcompensated for the little role which they function. And therein lies the rub.
Quickly, see, my take is a little different. It is equally important to focus on the quality of growth, not just the number. But it might surprise you if I say that if we do come close to 5 trillion mark, it would mean that our real incomes would have also come. No, not an assumption. I'll tell you why. So I said there are 3 components to this 5 trillion business. One is the real growth, the other is inflation, the third is what happens to our foreign exchange rate. Under the new monetary policy regime that we have, the MPC, inflation has to be curtailed within 4% plus minus 2. And RBI, unlike in the past, is answerable to the parliament. Do you know, since this new regime came into play in 2015, there has been only 1 month where the inflation breached that 6% target. Every other month, it has been within the stipulated target. So I don't anticipate RBI slipping on this, which means inflation will remain benign around 4.5%, 5%. Now the question about the foreign exchange. I do not foresee too much of a depreciation on the rupee. In fact, I foresee stability. And if you are lucky in inviting and attracting foreign capital, I would see even anything between 5 to 7, 10% appreciation in rupee. Now, if that happens, it implies that the real growth is going to touch close to 7.5%, 8%, or even past 8%. If we have that kind of real growth, and we keep an eye on the quality of this growth, where is it coming? That's why the reason I was saying 5 trillion economy will not come from industry and exports. It will come from there, but we have to set straight what is happening in the agriculture sector. So if this kind of a configuration plays out, we would actually have doubling of income. If you look at the real incomes, if you look at the recent demographic trends, contrary to what is expected, in fact, India's economic survey has got a chapter on the recent demographic changes in the country. You would be surprised to see that even the so-called the Indo-Gangetic heartland, which was known as the so-called Bimaru states, population has started stabilizing in West Bengal. So the real per capita income could distinctly come close to doubling if we get to the 5 trillion mark. And for that, the policies need to be taken in a whole lot of areas. Cannot be industry or export focused policy. We need to straighten out the policy environment there, but we need to settle the problems in our agriculture. Thank you.
Hello.
Mr. Simsali, please. Please introduce yourself. I'm Anand Pratap Singh. I'm economist with Punjab National Bank. Sir, you mentioned about the spread in banking business, deposits vis-a-vis advances. So you said that spread is increasing and we have to reduce the spread in order to make the advances more competitive and beneficial. Now what is happening, the big push which is coming from the government side for MSME advances, many of them are converting into NPAs. Particularly this Mudra scheme, Prime Minister Mudra Yojana, started in 2015, and already we are seeing a big chunk growing into NPAs. So with the economy going bad and the global economy also not flourishing right now, this phenomena is likely to grow. So how will you, I don't see,
You are
I don't
only-
see anything
I will-
getting away from the fact that the spread will reduce.
You are only amplifying my point. The point is, there's a culture of, good depositors, whoever you are recovering your losses from future depositors. That's my point. And that is happening. So there has to be a culture of repayment of government loans. If everybody thinks that, okay, SMME loans will be waived, government loans will be waived, unless and until it is something like a Land Revenue Act declaration, where anything declared as land revenue, either you pay or your grandson pays. Somebody pays, these systems came up more than 200 years ago, that if there is a due on your land, you may not pay, but there is nothing happening. But if you want it to be free, at least your grandson will pay it. But there was nothing which is free. But you are actually amplifying the point which I am trying to say, that unless and until there is a culture of repayment, good people who are depositing money, you are recovering the losses from them. You have just confirmed whatever I said, and that's my point. And that's not the good Lakshan for a $5 trillion economy.
Thank you. We can actually go on and on. It's absolutely, exciting to hear you. And just one second, please. So thank you again. Before we wrap for the session, a small memento to Mr. Sivasailam, Professor Rajkumar.